welcome to CrushTheStreet.com's weekly market wrap-up. Let's start things off in the equity sector, which posted some small gains today as the White House and Congress jostled over revised tax and spending cuts. For most of this week, the markets reflected optimism that a deal would get done, despite the politicians suggesting otherwise. The only sell-off this week occurred on Wednesday the 19th. Looking ahead, if investors continue to hold misplaced confidence in our government to spark an economic recovery, we would then expect a rising floor of support that should prevent the Dow from dropping below the 12,900 mark. However, going over the fiscal cliff will surely negate that forecast. Also, continue to keep a close eye on the declining volume levels. A rising equity index in this case is more of a warning than a bullish indicator. Of course, the recent upswing in the equities comes at a price: dollar devaluation. None of the key proposals that are designed to stimulate the economy involve the Fed not touching the printing press. Because of this, we made the call that the dollar would weaken and possibly challenge the 78 level, which it is very close to doing as today's session ended at 79.26. Will it continue to weaken from here? The bearish momentum certainly suggests so, but we've had about a week and a half of continuous declines. The odds suggest that some dead cat bounce will occur. When I look at the technicals, I believe we are seeing a broadening wedge formation, which is a very complicated and rare pattern, but it's basically a bearish wedge in reverse. If indeed a broadening wedge is in play, we would expect a pop up in the dollar, which you would assume would pressure commodities and precious metals. However, some of the key fundamentals have been thrown clear out the window during this week's market action. The dollar has been in free fall, which is inflationary, yet spot silver lost 10% of valuation from the week. What gives? There are two factors to consider. First, investors have a lot of misplaced confidence in the economy, particularly the phony baloney jobs report. They see a declining unemployment trend and therefore less of a need for unproductive metals. Second, December being the end of the year, a lot of fund managers have exited their positions to rake in precious profits, as they've no doubt been taking beatings in other sectors. So the weekends have finally left, and it's a great buying opportunity, right? I'm going to say no for the near term. Here's a couple of things to warn you about. First, the volume in the metals is ugly, and it's going to get uglier next week, which is holiday shortened. Second, as of the recording of this video, we're seeing zero support from the overseas session, which could mean either another gap down day tomorrow or lethargic price action. Both would be considered bearish for silver. Finally, we've gone through every line of parallel support with today's price action. The only thing left is horizontal support at $28 and the big one, $26. In the near term, there's more momentum on the short side, but even there, it's too risky at this point. Two bullish scenarios could develop from here. One, a double bottom formation occurs at $28 and swings the price upwards, or an inverse head and shoulders pattern develops shortly with a bottom coming in around 29. Either way, it's going to get ugly, but the fundamentals should smooth things out, but I'm wrong on the call for upside in December. This forecast will have to be pushed out until late January or February. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.